Hi, Tom Parrish here from Parrish Real Estate. How are you today? Hey, this is our first weekly market update on the local Spokane housing market. Okay, so look for our videos each Monday. Also, I posted a video on the Fed, why they're raising interest rates and what effect those interest rates are having on our local Spokane market yesterday. So please go back and review that video. A question for you to ponder today during this video is, do you believe that we are in a healthy housing market, that we've been in a healthy housing market for the last 2 years? Okay, and I'll address that question throughout and at the end. Okay, let's jump right into today's topic as we have a lot to cover. What we're trying to do today is we're trying to discern the health of today's local Spokane real estate market. And why we're trying to do that, we're trying to help buyers and sellers, and sellers that are sitting on the sidelines and trying to decide, do they want to buy and sell or do they want to just wait? What would be the best thing to do? Okay, so what we want to do is look at 4 metrics today to try to understand what is the market doing and where is it going. Okay, so first of all, we're going to look at the contract ratio. And the contract ratio is simply a metric that we look at, the total number of pending houses for sale versus the total number of active houses for sale. In January, that was 70%. So that meant 7 out of 10 houses that were in inventory were actually already pending, so not available for you to buy, and only 3 houses out of 10 were there for you to buy. Okay, now that has fallen in the last 9 months down to 40.2%, a huge reduction over the last few months. Sounds very negative, doesn't it? Well, it is definitely tells us that the market is slowing, but let's look at it from an historical perspective to determine, is it in a negative area or is it still in a positive area? And if you look at 2017, 18, and 19, which were very healthy real estate markets, meaning balanced. When I say healthy, I mean balanced. Neither sellers nor buyers are dominating. They're both on the same level. Well, if you look at it back compared to those years, our contract ratio ran in that 40 to 50% range. So we're in a very healthy range right now, much healthier actually than we were back in January. So that's a good thing. We're going in the right direction. Okay. Second metric we're looking at is inventory. Inventory is an important metric because it measures the number of houses that are for sale on the market at any one time. And if inventory is low, it usually means a seller's market where housing prices are rising, right? Because you have steady demand, you have low inventory, so that's this situation where you have multiple bidders on a house pushing housing prices up. And of course, the opposite is just the opposite, where if inventory is high and demand is steady, then you're going to see prices probably coming down. Okay. Now in Spokane right now, our inventory sits at 2,520 homes for sale. Now, what we do is we look at it in terms of how many homes does that represent in inventory for sale. So it's 2.5 months of inventory for sale in Spokane. And so the way to think about it is, if we don't let any other sellers come on the market, it'll take us 2.5 months right now to sell off with the demand where it's at, 2.5 months to sell off all the houses that are available for sale right now. Okay. If you look at that in comparison back to January, in January we were at 1.3 months of inventory. So we've essentially doubled our inventory in that time period in the last 9 months, which again sounds negative, but let's look at it on a historical basis. On a historical basis, 4 months and less is still considered a seller's market. So we're only at 2.5%. So there's room to grow to get to that balanced market where neither buyers nor sellers dominate. Now, it's considered a buyer's market if it's 6 months or more in inventory. So again, we're only at 2.5. We actually want to get to that 4 to 5 to 6 range so we come back into that healthy area. So we're actually moving in the right direction. Okay. And that's what the Fed wants to see anyway. That's why they're raising interest rates. Now, we get a lot of folks that say, that are asking, is inventory just going to keep rising and rising and rising, and which is going to continue to push housing prices down and down and down, and we're going to somehow have a crash? And the answer to that, and not just from me, but from most economists in the US, is no, that's not going to happen. There are doomsdayers out there that'll tell you that. But here's why. Mortgage rates have been at their historical low for the last several years. most homeowners either have their current mortgage or they've refinanced to a 3% or less interest rate on their home. Interest rates are now above 7%. So a lot of those folks who have those mortgages, again, most of us, they're looking at it and saying, hey, do I really want to sell my house and go buy another house with interest rates as high as they are? I'm going to go from a 3% to a 7% mortgage. And what that's going to do is it's going to keep a lot of sellers on the sidelines. And they're not going to sell even though they would like to. Okay, and so that's going to keep inventory at a reasonable level, and it's not going to make it so it rises too fast or too high and we see some crash. Okay, so the third metric we're going to look at is the median sale price of a home. In April, the median sales price was $450,000. It's $420,000 here in October. So definitely coming down. It is telling us that the market is slowing, and some housing prices are actually coming down from where they were in April. But let's look at it compared to last year. Well, last year, at the same time, the median sales price was $389,000. So $389 versus $420 this year. So if you bought last year at this same time, a lot of people are saying, oh, I'm underwater. No, you're not underwater. You still have very nice equity in your house, okay? So from a median sales price perspective, again, looking at it and getting some basis for that, looking at what it was this time last year, tells us that, hey, we're still above last year, which was above the year before, which was above the year before. So we're still in a great range. Now, the fourth metric that we're going to look at are foreclosures. And over the past 2 years, foreclosures have risen 100%. So from Q2 2020 to Q2 2022, they have actually doubled. Okay, sounds ominous, right? Well, again, we have to get some perspective here. And if we look back at 2017, 2018, 2019, which were reasonably balanced markets, foreclosures were actually double where they are right now. Okay, so that tells us again that foreclosures are increasing, which is never good, right? But they're still in a level or at a level way below some sort of crash or anything like that. It's just showing us, we believe, that we're in that correction. We're going from an extreme seller's market, which was extremely unhealthy, answering your question from the beginning, and we're balancing that market back out. And that's what's happening right now. And we believe it's actually very positive. So in summation, all these metrics are showing us that the market is slowing, housing prices have come down a little bit, and all that is definitely a positive. All right. So if you're a buyer, the next question is, should you wait on the sidelines and see if, things go, housing prices continue to go down and down and down, down, down? And the answer to that is, it depends. Okay. If you are a buyer and you have a short window, so let's say you're somebody who likes to flip houses. I do not believe this is a market that is good for flipping houses. I believe that if you are going to buy and hold your real estate either as a rental house or a primary house, and you have a window of 3+ years, and the longer that window is, the better, then there is absolutely no reason on the planet not to buy that house right now. Okay, and if you look at my Fed video, that'll help you with what I'm saying right now. There's too much to go back into on that, but it'll explain why we definitely feel that way. Okay, so if you're a buyer with a long-term perspective, meaning 3+ years, 3 years or more, gosh, don't wait. Get out there and buy that house and live where you want to live, and enjoy your house as it will appreciate. And that's why it's called the American dream in the first place. Okay, now if you're a seller, should you be looking at selling your house or sitting on the sidelines? Again, the answer is it depends. And it depends on what you believe interest rates are going to do going forward. Now, in that video on the Fed that I posted yesterday, I told you why we believe that interest rates are going to continue to go up into 2023 most likely, but then in 2024 and certainly by 2025, interest rates are going to be starting to be cut and come back down. Okay, if you believe that, then there's no reason to wait on selling your house, right? Now, some of you are going to say, well, I can't get now from my house what I could have gotten in April, so I want to wait. Well, You don't have to, and here's why. In April, yes, you would have got more money for your house if you had sold then, but you didn't, and you're going to get less. But the house you're going to buy is also in the same situation. You would have had to pay more back in April for that house than you have to pay for it now. So it's essentially a wash. The only question you should really have is, do I believe interest rates are going to continue to go up and up and up and up for the next 5 or 10 years? Or do I believe they're going to go up in the short term and then they're going to come back down? And again, if you believe they're going to come back down, go sell and buy right now and live where you want to live. If you don't believe that, you think they're going to continue to go up, then by all means, go ahead and stay on the sidelines. So that's it for this week. We look forward to seeing you again next week, and have a great week. Bye.